So, hello friends. Today we are going to start with the first session on this series on e-learning of derivatives. So, today's session will cover the introduction to derivatives. What we will cover in this session? So, we will start with the meaning of derivatives, the evolution of derivative markets, the functions of derivatives markets, the types of derivative products and the markets, and the key participants in derivative markets. So let's begin with the first meaning of derivatives. Okay. So what are these derivative contracts? So basically, a derivative is a financial instrument whose value depends upon or is derived from the value of other more basic underlying assets. That's why we call it a derivative. That a derivative has no value of its own. Its value depends upon or is derived from the value of the underlying variable. Okay. Now, what is this underlying asset? So, every derivative contract is based on the value of some underlying asset. This underlying asset can either be a real asset. What do you mean by a real asset? A physical asset. Okay, something which you can touch, which you can see. Okay, so real assets like commodities, or the underlying asset can also be a financial asset. Right now, we are all aware of financial assets like stocks, bonds, and currencies. So, derivatives can be based either on a real asset or on a financial asset. The important thing is that the value of the derivative contract changes as per changes in the value of the underlying asset. Okay. Now, one other distinction between a derivative contract and a normal asset. Suppose I held shares in Reliance Industries, right? The holding of these shares confers some rights on me. For example, the right to receive dividend from the company, the right to receive bonus shares, the right to attend the annual general meeting of the company and vote on matters which are important, right? But if I own a futures contract or an options contract on shares of Reliance Industries, then I have no such right. The reason is that I am not holding the actual shares, I am merely holding a derivative contract on the shares of the company. So, derivatives do not confer any ownership rights, okay, on the holder. So, what are these contracts for? A derivative contract is normally an agreement between two parties to buy or sell the underlying asset on some future date. It can also be a promise to exchange cash flows at a defined future date. So basically, these are contracts either to buy or sell the underlying asset on some future date or to exchange cash flows on some future date. The important thing is that these contracts are legally binding contracts. What do we mean by this legally binding contracts? Suppose I have entered into a derivative contract on some underlying asset, okay? And suppose the party with which I have entered the contract, that party defaults on their obligations, then I can sue the party in a court of law. So, it is a legally binding contract. So, what are the different types of assets, okay, on which derivatives can be traded? So, the first and the oldest type of contract is the commodities. And derivatives are today available on different kinds of commodities. For example, energy, okay. So, we have derivative contracts on crude oil, natural gas, on electricity. We also have derivatives on agri commodities like sugar, coffee, jute, cotton, okay, cocoa as well. And then we have contracts on base metals. What are base metals? So metals like copper, zinc, okay, nickel, these are called base metals. And we also have contracts on bullion, okay. Bullion, what is bullion? So typically gold, silver. So we have contracts based on bullion. The second asset class is currencies, okay. So we have derivative contracts on various currency pairs. For example, Euro USD. So this is the currency pair which is, the largest traded currency pair in the world globally, the Euro USD, the Euro dollar. Okay. Then the GBP USD, USD JPY. Okay. So all these are very, very popular currency pairs on which derivatives trading takes place. We also have derivatives on interest rates. Okay. So both short-term interest rates and long-term interest rates. So in the short-term interest rates context, the euro dollar futures contract is the most heavily traded interest rate contract. And then the treasury notes, the the 10-year treasury note futures contract. That is again a very, very heavily traded interest rate derivative contract. And lastly, we also have derivatives on stock indices and on individual stocks. So, for example, one of the most heavily traded stock index derivatives contract is the E-mini S&P 500 futures contract. Okay. In India, of course, you are all aware of the Nifty and Bank Nifty futures and options contract. Okay. So these are the different types of assets on which derivatives are available. So before we move ahead, a quick question for you. Which of the following is not a derivative? 10-year government bond futures contract, an option on Tesla shares, the Euro USD futures contract, and the RBI repo rate. So before we move on, just take a couple of seconds and think about this. So yes, which of the following is not a derivative? It's the RBI repo rate. All the other three are futures and options contract which are based on some underlying asset. Okay, but the RBI repo rate is what it is. It is an interest rate. It's not a derivative.